Hello and welcome to the Be Formless Flow Driven CEO podcast. I was meant to say VC podcast, but that's okay. CEO, VC podcast. We're going with the flow here and we are reshaping life, leadership, business and investing. And I am welcoming from Rotterdam in the Netherlands, Daniel Faloppa. Welcome to the show, Daniel.
Thanks, B. Thanks for having me.
No, thank you. It actually does work because you are the founder and CEO of Equidam. So, that actually works, what I've just called out before. But Daniel, I am super excited to be talking to you because you have some very new news to share with us. But I want to introduce you and take you right back to when you were 12 years old. And I'm going to start with, you're the founder and CEO of Equidam, as I just mentioned, which is a global startup valuation platform. And it's used by over 160,000 founders across 90 plus countries. And it's to bring transparency, structure, and data-backed clarity to fundraising. You're an entrepreneur and programmer who began coding at 12 in the Italian Dolomites. Wow. And you have spent more than a decade operating at the intersection of technology, finance, and venture strategy. In 2012, it's when you founded Equidam, and it was a simple belief: startup valuation should be valued, not priced. I absolutely love that. Grounded in a method, not mystery. And through Equidam, Daniel, you and your team has helped reshape how founders and investors think about valuation. So it's moving it from opaque negotiation to structural analysis. I think you'll need to explain a bit of that to the audience for us, please. And you've also mentored hundreds of startups across 40 plus global accelerator programs, including the likes of Virgin startups, Microsoft startups, and Startup Wise Guys. And most recently, very, very recently, I think it was mid-Feb, but you'll be able to share it. You can give us all the information on that or the download. Equidam announced its merger with Share Council, which is Europe's leading co-ownership platform to build integrated infrastructure for valuation, cap table management and equity administration across borders. With the European Parliament advancing standardized ESOP frameworks, EU included, Daniel's focus is clear: make employee ownership dependable, compliant and accessible. And you have this huge mission, which is to enable 1 million co-owners to do this by 2030. Your philosophy is long horizon and systems driven. Great companies are built through clarity, perseverance, and aligned incentives, not hype cycles. That is one of the longest bios I've read, but we had a lot to
Well, it's very detailed, yeah.
Yes, I'm going to hand it over to you, Daniel, to tell us. Let's go right back to when you were 12 and how you started this.
Yeah, it's a crazy journey, right? Because, well, I come from a very tiny village in the Italian Alps. It's about 500 people and like probably more cows than that. And it's a touristic place, but it doesn't really have much going for it. And especially in the winter, there wasn't much to do, right? And so like really I always had this pull for computers and informatics in general. Yeah, I think like I was speaking with somebody the other day. I don't remember who was the exact person, but there was a kid somewhere and he showed me like Visual Basic at the time. And he was talking about, making little programs from Excel, because in Excel you could use macros to make programs and stuff. And so like, through that, like kind of started coding and really got this attraction for the fact that you can build for free things that are standing on their own and they're helping other people and they are doing things for you and for others. And I think it had this very much this egalitarian pitch to it, right? Anybody could do it. You just had to learn, right? And so that really took me down a very deep rabbit hole of computer and coding and everything. And at some point, I ended up studying the TCP/IP protocol, and like it has 9 layers, and it was like a book of like 1,200 pages. And then I said, okay, if I continue down this route, I'll never gonna leave my room, and I'm gonna like lock myself up in a dark place and never speak to anybody again. And so I thought, okay, I cannot do that long term. Like it's not very, very healthy. But the passion for it was extremely strong. But then I said, okay, let's sort of fall back on the second passion that I had at the time, which was finance, which almost goes in the same direction of like helping people without resources, but with ideas and with knowledge and so on, getting those resources, right? Like that's kind of like the best pitch for finance. I know it's not always seen like that, right? But I think in the best way, it has potential to equalize things for everybody, right? And so then, I ended up going into finance with a direction towards investment banking and graduating and so on. But then I didn't like that direction in terms of like what the job would actually be. And in a sense, I ended up thinking to go back to computers and like the intersection between computers and finance and coding and finance, and ended up starting Equidam in 2012. We started as a blog, really like trying to help entrepreneurs figure out finance, because a lot of entrepreneurs, they come from all sorts of backgrounds, as you know, but rarely they come from finance, because they need to have domain expertise, right? And because of them not coming from finance, there is such an opportunity to teach them something and for them to make a big change. And so we started with this blog, and then the question kept on coming: how do we calculate valuation for our company? We need to raise capital, we need to sell the company, and so on. And so, with the background in computer science, I was like, okay, we can do something about it. It's not rocket science. We can help a ton, point people in the right direction. And this was 2012 in Europe, right? So angel investing was very much not established. VC investing as well, right? Valuation methodologies, not really. Valuation data, startup data was not there. So it was a lot of fun. It was a lot, and at the beginning it was really controversial. Like we got a lot of feedback of like, what you're trying to do is impossible. That was the first sort of thing, right? Then the second thing was like, even if you manage to do it, is not useful, because valuation is an art, and everybody wanted to keep their cards very much close to their chest and not share how they would calculate things for fear of losing leverage in negotiations, right? But then we got connected with, and this is a long story, right? But we got connected to the equity crowdfunding industry, which actually started in Australia. I met back then, and I spoke to him the other day. Paul Niederer was the CEO at the time of ASOB, the Small Business Board of Australia, which was kind of like the first private company stock exchange in the world, let's say, which kind of started a bit the equity crowdfunding
That's
thing.
fascinating.
Yeah, which actually started then here in the Netherlands, and then it expanded to the UK, a little bit in the US. It never really took off, but we got pretty quickly as Equidam to help about more than half of the equity crowdfunding platforms in the world. And that was kind of like how we got started. But then that industry never really went very far. And so we branched out into traditional funding rounds, traditional, let's say offline funding rounds in a sense. And that's what we're still doing now, together with exits, together with investor portfolios, consultants, and so on. And now, as you correctly said, like the last sort of step in this long saga is the merger with Share Council, where we really see a clear synergy between cap table and valuation, where people that do have their shares on a cap table, they're always wondering how much they're worth. If you want to do employee stock option plans, you need to calculate valuation regularly. Like, big synergy there. And it's very exciting to see where we can take that.
Was that always your dream? Like back in 2012, if you look back now and, kind of sit here and, smell the roses, so to speak.
I mean, we always started with the idea of being successful. We did not really know what that meant, right? We knew very, very little. And like, it's kind of like the reverse of what I was saying. We did have a background in finance, but we didn't know anything about anything else, right? So like marketing, strategy, hiring, like HR, legal, like we didn't know any of that stuff, right? And so we had to figure all the other pieces out. But the dream was to empower valuation for all private companies worldwide, as not only for transactions, but also just for internal information and reflection of valuation has this really unique quality that it puts together the future potential of the company, but also the future risk, right?
Yeah.
And so you could theoretically compare strategies in the best way possible, because you're not only taking into account how big something is going to be, but also what's the probability gets there. And so the dream has always been to serve the global startup community with valuation. Yeah.
I love it. And I love that you talk about the double-edged sword, like, what's absolutely possible, but also the risks associated. And because you always talk about scaling, but then there's almost like the risk associated, and at times you have to descale. And you almost have to go backwards to go forwards again. And I think that we don't talk about that enough, in in the startup ecosystem, the founders, and, it's always around, like, these big pipe dreams, if you like, and
Yeah.
what's possible. But, that from a valuation perspective or sense, and the reality of here's this and here's that.
Yeah.
So that strategically, how do you manage that in a really uncertain and rapidly changing world as well?
Yeah.
Like, yeah.
Yeah. Yeah. And there is also some counterintuitive cases that people don't think about. Like, for example, sometimes doing something smaller or less ambitious might be riskier, right? Because the better strategy would be to be more ambitious, and you would get better talent, and you would get more funding, and you would be like, you actually have a higher probability of success that way rather than the other way around. Or we just did an article yesterday on the valuation of hit businesses, right? So if you think about music businesses, the gaming industry, movies, right? You can have a game that is extremely successful and goes extremely big and generates incredible amounts of cash flow. And the company is going to be worth a lot, and it's like 10 programmers, right? But when you start out, you cannot project that. If you project that, then your valuation is going to be extremely high, and that's very difficult then to sustain. It's difficult to claim that you're going to make a 0.1% game, right? So in that case, if you think about, okay, what kind of game can you on average produce, then that becomes a much more interesting valuation. So yeah, this view of like, not only what's the potential of something, but like, what's the risk, what's the probability that it happens. It's why valuation is very interesting for me. Yeah.
Yeah, and do you think valuation is, like, it's obviously been around for quite some time, but do you feel like it's more important than ever? Like, do you think it's something that we're going to, yeah, like, in terms of, I don't know really what I'm asking here, but, it feels like, yeah.
It's interesting. Like, so you have the methodologies of valuation, like, it sounds like very scientific, right? Because every advisor and every professor is like writing a lot about, but it's a fairly new science, right?
Yeah.
And it's a fairly new way of looking at things. And a lot of the methodologies, a lot of the coefficients are fairly new. And right now, what happened is things got pretty clear during the SaaS era, right? So the SaaS economics were starting to be understood, the way to scale a SaaS, everything was becoming more predictable, the way to invest in a SaaS and so on. And so also the valuations. And now we got completely slammed by AI, mega rounds, companies like being able to raise in other industries like energy and biotech and pharma and so on. And that has completely changed the game, right? And so a lot of investors, a lot of companies that were maybe versed in understanding economics and values of this type of SaaS companies, which were fairly predictable, without knowing the fundamentals of valuation, now they are like scrambling because they don't understand the new type of companies, right? And so I do think, like, if you understand like a few core principles, it helps a lot in figuring out what matters for funding, for strategy, and for valuation. Yeah.
And what do you see as the core principles, the few core principles then, Daniel, especially like in terms of the revolution we're currently in then?
So the core understanding is that what we were talking about before, that valuation is a combination of risk and return,
Yes.
right?
Okay. Yeah.
And yeah, and so like when people go and try to estimate their valuation, and when they try to go and negotiate it, then the feedback that they get needs to be seen under those lights, right? And you see a lot of rejection online on, like, for example, you don't have enough traction, right? So that's a risk feedback, right? So maybe, and it could be that the company has not enough traction, but it could also be that you haven't communicated the proposition well enough to make people understand what's the actual level of risk of the company, right? So it's difficult to communicate the actual risk of the company because you're inside the company and you know everything. But when you go and present, people don't know everything about it. So like, interpret that feedback around risk and return. Feedback like the market is not big enough, that's more around return, right? And that's a lot easier to change, especially when you're early stage, like to change your proposition according to that feedback. And you don't have to. That's not the best way. Like, you shouldn't change everything you do based on like the feedback from investors, right?
Activity.
But you need to adjust your strategy based on the feedback of the market and the resources that you need for that strategy, right? In order to make it really work. And so when you talk to like 3, 4, 5 investors and they have similar feedback when seen from the lens of risk and return, then you can adjust your story, which in a sense is your product that you're trying to sell to these VCs, and include that feedback, and then go and talk to investors that you really aim for, that you really care about, and you have a much stronger proposition for them. Yeah.
Yeah. Tell us a little bit about what you're seeing with the founders in terms of just in this space and obviously these core principles. Like, is there a huge education or re-education, if you like, given that we're in, we're almost in between two worlds, or we're in a new world, but there's a lot we've still shaking off from the old
Yeah.
world, if you like. Yeah.
Yeah, for sure. So there is a we used to laugh with Dan Gray when we were doing podcasts together on like how little is known about financial principles from the point of view of founders, but also from the point of view of investors, which is actually their job, right? And
Yeah.
also like some basic principles like diversification, or this like sort of risk and return dynamic, or are really not well understood. And now when you go into completely new dynamics, completely new sectors, I think, in the end, the difficult thing of venture capital is that you see results after 5 to 10 years, right? And you have so little data to understand whether you're doing well or not. Plus, you could just be extremely lucky, right? But if we don't want to rely on luck and hype, then I do think knowing at least some basics would go a very, very long way. For founders now, when you see OpenAI raising 110 billion as a private company, setting new records, when the amounts get bigger, investors get more professional, right? And so you can hire for finance, you can hire strong CFO and so on. But the more you know as a founder about finance yourself, the more you're going to be able to hire a better CFO or to have those conversations yourself, right? And in the end, you're going to be the one that has to pitch, and you're going to be the one that has to make certain decisions. And so like knowing a little bit about finance helps. Founders evolved a lot, right? Over in the past, like let's say 15 years that I've been doing this. But I feel a lot of the knowledge that they have now is superficial, right? So they read they read about a comparable method, right? And so they go like, oh, I should compare myself with other companies. And then they go and look up other companies, but they don't understand why, right? Why is that? Why should you, and what should you look at in those comparable companies to make sure that they are comparable? Hint is about risk and return again. But so I think there is a lot of edge to be gained in knowing a bit more about finance, especially when you go after those big rounds and those big things. The other thing that is critical is to also understand, what if you don't? So there are several strategies. Like there isn't only OpenAI is not the only strategy, right? These mega rounds and this rocket ship growth is not the only strategy, and it might not work for every business, right? And the trade-off there is the more you raise, the more you raise expectations about the company, right? Because again, valuation is about risk and return. So if you raise a lot for a small percentage at a high valuation, it means that you are implying a lot of return with low risk, right?
You gotta hit those numbers.
Exactly. Yeah.
Yeah.
And so you're giving yourself much less margin of error, and you are lowering the probability of hitting them because they are naturally higher, and which might be fine for you, right? You might be like, all eggs in one basket type of guy with like no family or girl, like, with no obligations and so on. But it might also not be the right thing for you. And it might also not be the right thing for your business, right? If there are still some fundamental questions that need to be answered in the business, and you raise a mega round and you have a VC that is pushing for growth, you're not going to have time to figure those questions out. Then you're going to push the accelerator in a direction that maybe is not the final one. And, 1 degree off, and you're going to be, not surviving, right?
No, I agree. I really like where you're taking this conversation in terms of, it's almost like at all costs is basically what you're talking about here. And in terms of, from a business perspective, but also from a personal perspective, because, the higher the valuation, and sometimes the risk is also then, like you say, like you can be working up to 80 to 100 hours a week because, you are having to work 24/7 to hit, and I loosely call it hit the
Yeah.
numbers because, it's always, like when you've got investors involved, it is that you have to show the return, you have to show that the business is performing, because as soon as it's not, or you're not on target,
Yeah.
it's like, what's going on,
Yeah.
And so so for me, I'd be really interested to understand, you talked around, my ears pricked up when you talked around this new science, in terms of new science when it comes to valuation. I also think there's, a new style of leadership, or a new style of founder, that needs to be able to sustainably grow and thrive themselves without burning themselves out, without cooking
Yeah.
themselves. Because if the founder's cooked, or if the founder's completely, exhausted, they're no good to the business. They're
Yeah.
never gonna hit the targets. And so it's kind of like a recipe for disaster, if you
Yeah.
like. And so how do you reshape that? How do you do that differently for the mega
Yeah.
rounds?
Like the high effort is important,
Yeah,
but
agree.
it needs to be, I think it needs to be classified according to how much creativity and challenge is required, right? If a ton of creativity is, you're not going to be creative after like 12 hours of
No.
work, right? That's just impossible. So and like if you see even OpenAI, right, in terms of like its lab, it was a lab for a very long time, right? And like that's what created this creativity. And also they failed a lot, right? They created a lot of things that didn't go anywhere. It took them 10 years to make the first ChatGPT or something like that, right? So you need to understand for your specific business what's optimal. And again, and this is like the same story, it might be that raising a lot of capital, pushing on the gas like crazy is not actually reducing your risk, but it's increasing it, right? And so in that case, why are you doing it, right? And then yeah, on the personal side as well, I think there is a lot of startup culture around, indeed, like pushing the limits, raising the capital, being pushed from outside to go even further. But there's also a lot of success in companies not doing that, right?
Yeah.
And in companies doing what I think is wrongly named traditional entrepreneurship. The whole thing is entrepreneurship, right? It's just different strategies. But like this type of companies that are maybe growing more patiently, they are more, yeah, they have more room for error. Sometimes what happens is when you raise venture capital, it comes also with like liquidity preferences and all those causes, right? So it skews the return for the founders. If you want, we can talk about that. But I think your audience knows what a liquidity preference is, right? So when that return is so skewed, right, it means that you're gearing your returns as a founder even further into like this risky territory, right? It's all or nothing at all costs, right? And if you look at the probability distribution of like, say, making your internal goal, right? Whether your internal goal is like to live off forever of the exit, or to have enough cash flow every year to, again, to not have to work, like that's, reasonable goal for a lot of people. It might be that that's much more achievable without venture capital, without liquidation preferences, without even an exit, right? If you manage to make a sustainable, healthy business that every year generates a profit, it doesn't need to be huge. It can already achieve that goal with a much higher probability compared to go through the startup route, raise VC, push on the gas like crazy, burn yourself out, and then hope in that exit to Google, right? This is another thing that founders should consider, and that
Yeah.
finance can help consider. Yeah.
I'm interested. It's so true what you just said. You just mentioned traditional entrepreneur, and just like in terms of traditional entrepreneur, I have not heard that term before. Gosh, call me like ignorant, but like, is that in terms of what you mean in terms of slow and steady wins the race, like not, or traditional being bootstrapped? What do you mean, like?
I think there is um, like a gatekeeping phenomenon of the startup community, right? So the first thing is that you call these companies startups. So the original startup term, like like a new company, like a young company, like that's super fine, right? But then it got morphed into startups are like this digital Silicon Valley winner
Yeah.
takes all digital companies, right? And so that got put in juxtaposition with traditional entrepreneurship, companies that don't call themselves startups, maybe companies that like open a factory and they make tables, or hotel chains or gas station chains, right? And strategies around, for example, growing through acquisitions or other things that are not like traditional startup strategies, right? And then what you see is that VCs and early stage investors and angel investors, that whole world has been created around startups, right? It's kind of like, and it becomes more and more separated. And then
Yeah.
on the other side, you have what I call like traditional entrepreneurship. But again, it shouldn't be distinct. And sometimes the opportunities there are much, much bigger, right? There
Yeah.
are like, especially these days, right? It's incredibly hard to find a plumber, and it's much, much easier to code your own app, right?
Yeah.
Which is the reverse compared to 4 or 5 years ago, or well, maybe 7, 8 years ago, right?
Mm,
So
mm.
so another thing is this idea, this sort of getting immersed into the startup culture might blind some founders and some entrepreneurs from like all this other world that is out there of
Opportunity.
opportunity. Yeah.
Fascinating.
Yeah, it's probably because you told me like your background is more like on marketing and on that side, and I think maybe that's like sort of less divided, right? Maybe like you don't feel the divide in that way. But I think there is a clear, at least in sort of investment VC land and stuff, there are these clear like boxes of like, okay, you fit into this box, you don't fit into this box, and it's in my opinion incredibly damaging for everything.
And so do you think then that's where there is a huge opportunity for the VC ecosystem, if you like, to, you're a shaper, I'm calling it shape shifting, you reshape things, you shape, you reshape.
Nice.
Like it is kind of like you're saying
Yeah.
compartmentalized at the
Well, they
moment. Yeah.
for sure, and that's why they've been going through a lot of pain, right? So what happened in the past couple of years is that in 2022, like the good VCs, the ones that managed to raise, because it wasn't a great year, but they raised to invest in more SaaS startups and so on, right? And so that's in their mandate, and those are the economics that they planned for. And then the whole sort of AI wave took over and made creating these SaaS companies much cheaper, much easier, competing with them much cheaper and much easier. And at the same time, it raised acquisition costs. As you probably know, marketing channels now are incredibly saturated, and it's very
Mm.
hard to get to the final customer, right? So the
Yeah.
whole economics of these SaaS companies changed completely. And these investors, they had the mandate to invest in these companies for the next 5 years, right? And so at that point, they really had to break out of those constraints and those thought processes and those moats that they dig themselves in, and change, right? And so like that's still happening, and the whole environment still hasn't figured out what's the next SaaS. I don't think, right? So what's the
Yeah.
next wave of technology or wave of entrepreneurship that can shape the returns? Of course, the whole AI thing is interesting, but nobody has yet figured out where's the value of AI, right? So the big companies, of course, making foundational models, but they are requiring billions of investments. And on the other hand, like a lot of these almost AI wrappers, little AI created apps are incredibly competitive. So like, yeah, it's still difficult to find value there. Where there is value and where things are slowly turning is towards traditional, again, type of modes, which is why it's very useful to look at entrepreneurship, right? Things like brand, things like data, hardware, research, patents, and so on become much more useful because they are modes that a traditional software company doesn't have.
Well, yeah, and for me, it's like storytelling. It's like this new knowledge economy, right? Like, is like obviously you've got your LLMs, you've got
Yeah.
your AI, but from a human perspective, this is where I think there's we're going to see a lot of, I think there's a lot of opportunity, and we're going to see some very new styles and types of entrepreneurs, founders, businesses that, from a creative economy, all of that coming into their own. You talked around hit businesses, for so long, SaaS, like you say, has been like the front runner. It feels like we're about to see a bit of whether it's a role reversal, but like I even look at from a marketing and advertising lens as well. I see a whole new model.
Yeah.
And it's
Yeah.
traditional evolving, if that makes sense. Like it's not dying, it's evolving.
Yeah,
Um,
because the power is so much more with the distribution now, right? So for a long time, the power has been with the production, right? You could have all the distribution, but you didn't have like
yeah,
software to serve your clients because it was hard to build it. But now it's extremely easy to build it. And so like if you do have the distribution power, then you can do almost whatever you want, right? That's why influencers, like, they can almost do whatever they want. Some of them make shoes and some others make makeup. It almost doesn't matter. They have the audience and they can access it easily. And so they can sell something to that audience. So yeah, so that's a massive shift. That's a massive shift in economics of
yeah.
entrepreneurship.
Tell us quickly a little bit about the merger, Equidam. What was that like for you in terms of, obviously, was it a long time coming? Was it something that,
Yeah.
was it a surprise? Like, yeah.
Yeah, no. So it was very connected with this theory, right? So because of this shift in economics, companies that are doing, say, a slice of the customer need, it becomes much harder for them to be able to handle the economics of accessing that customer, right? The customer acquisition costs. So for us, it was clear that our customer acquisition costs were rising, but then our value to the customer was fairly stable. And so we had to add something for the same customer, right? So it was clear for us that we had to do something radical to try to provide more value to the same customer. The connection with cap table companies has always been there for us. We worked with tens of them over in the whole world. And we still do, and we still will support them for the future always. But it's clear that we need to try to provide more value to the end customer in order to remain competitive. And so last year, I think it was around February, we started actually proactively to look around for a strategic deal that could help us in this different environment. And we talked with the hundreds of companies, and
Yeah.
the process, right? You work extremely hard. You have a hard time maintaining focus on the core business and the
Yeah.
strategic side. And you narrow it down. You have conversations. You have 100 planets that need to align, right? Timing, willingness of people, compatibility of teams, technologies.
About to say.
So there is like so many things that need to align, and in the end, like you narrow it down to a few companies, and you pick one. And for us, the merger with Share Council was a very good fit, also in terms of branding and culture. We
I was
joined on
going to
this.
ask you
Yeah,
culture and chemistry. It's just so important.
yeah.
Like, yeah.
Yeah, yeah, you're choosing your next partner, basically, right?
Yeah,
For a
married.
very long
Yeah.
time. Yeah, and so there was we've been knowing each other for a long time, and we've always clicked on branding and on like trying to do something more than just try to expand the company, and the idea of like trying to make more people co-owners of the businesses that they participate in, that they add value to, for me is huge, and it's one of the massive problems of Europe that is preventing Europe from being competitive on the global stage, is that employees don't participate in the value they create. And so what happens is there is a complete lack of scale up talent in Europe. So people that have gone through that phase and can help other companies scale. The reason is that if they were part of one of these super successful companies, they never got equity into them. And so their salary grew, the company grew, their position grew, but then they almost got these golden handcuffs. They cannot leave that company. They definitely cannot leave that company for a small company that cannot afford their huge salary and
Salary,
bonuses and
yeah.
so on, right? So then in the end, they end up being locked into this, and they still need to work really hard and so on. So they don't have time, they don't have money to be able to transfer that expertise to earlier companies. And so what you see in Europe is that everyone that has been very successful is either locked into one of these large companies, is in consulting or anybody or any other company that can pay them a lot, or is a founder again, right? And is like helping,
Fascinating.
doing their own thing. Yeah.
Yeah.
And so there is an incredible lack of scale up talent, which I think is the main problem. It's a bigger problem than capital in creating large companies in Europe.
I need to get over to Europe. I need to. I love like the scale up is so one of my favorite things because
Yeah.
it changes so quickly. But you're constantly shaping and shifting and shaping it and reshaping it.
Yeah.
go from 5 people to 10 people, you lose a client, you're like, "Oh, here we go again." Like, it's you talk
Yeah.
about risk and return. It's a
Yeah.
continuous cycle of risk, return,
Yes,
you know,
exactly,
and
and it
it's
can be fantastic. It can be a
yeah,
fantastic
highs
journey, right?
yeah,
So
yeah,
like for you with your previous exit, right? You can invest that in yourself in a sense. Go help a small company get
mm,
equity into that small company, and kind of do it again, right?
yeah.
And like that company is not gonna be able to give you a lot of cash right now, but they can give you equity, and if you grow it, right? There was a story many years ago on First Round Review, which was one of the great management say blogs about startups, and he was talking about this person. I forgot the name. They were specialized in internationalizing US startups, right? They did it at Airbnb, they did like Duolingo, they did a bunch of others, right? And every time they would just work there for like 3-4 years, make sure that that company could internationalize in Europe, and then leave, right? That's an incredible role, extremely useful. It can be extremely value add to have a person like that when you have to go through that process, and just doesn't really
I can
exist
tell you about
in
my idea post the pod, because there is something in like coming like I'm honestly shaping it and then shifting it and then off you go. Like it's like
yeah.
that ability, like you get the foundations in order, you get it to the where it needs to get to, and then it's like okay, it's like
Yeah, your phase is done, and you move on to the next thing,
yeah.
and you bring that specific expertise to the next thing, and it's incredibly useful. You can leverage it like crazy.
100%. No, there's something in that. I had another question for you. Okay, my next question, I've got two final questions for you because I know it's the start of your day, and I do need to go and take Marley Bob for a little walk. I know you got your dog, and we've shared
Yeah.
little dog stories as well. How long since you've had a holiday? Like you've obviously, like you say, there's a
Yeah.
lot of work involved when it comes to a merger, and like you say, you've got to keep the day to day running, but then you've got this other big project that is on the side, but it's consuming you. Like, how have you got any plans? Like, how have you been able to switch off? Haven't you?
Yeah, so like last years have been a bit intense. So I think that there was time off here and there, but I think like the proper holiday defined as like you actually manage to disconnect from the company and like
Yes.
to, read a book that is not about business or, you know, it was, I think it was at this point 3 years ago or something like that. It's okay. Like, it was a couple of years where the market went down from the highs of 2021, 2022. So for us, it was a few years where we really had to fight to keep our
Well,
revenue and keep
yeah.
our people and so on. And that is not really fun to do, in my opinion. Like, so that's stuff that you, I think, need to take a holiday from. What we are doing now with like this new focus and like all these new activities and so on is like very exciting. And so in that case, it's almost fine not to take a holiday. I think like
Energy
it's
shifts.
very engaging. Like you're just engaged, right? I think it's more like I see it as sort of defensiveness versus offensiveness.
Yeah.
For me, I don't know if everybody's the same, but for me, defensiveness is extremely burdensome and
Exhausting.
annoying, and offensive is fun. So I could do offensive like the whole day,
Me
every
too.
day.
I think about it that like dark and light energy, like offensive,
Aha.
defensive. Like defensive is dark energy. It feels really heavy,
Yeah.
and then when it's offensive, it's like, woo, yeah, like just getting up and like everything feels amazing.
Exactly.
And
Yeah.
it kind of is, I mean, that's the nature of, this what you do. And so yeah, I think that but I do also think that, even if you can't have a holiday, it's that ability to ensure that you have that active recovery baked into your
Yeah.
schedule. I'm a big believer in going and having like the, infrared or like doing a yoga class. And I think that is one thing that founders, it's the first thing you put to the side because you're like, no, I'll get to that later. It's not important, but it's so important because we
Yeah.
need to have back to clarity, back to what we were reading out in your bio, the ability to be
Yeah.
clear, especially when it comes to things like, you said in terms of the core principles of risk and return, you can't make clear decisions when you are completely
Yeah.
overloaded.
Yeah. And you need to think also like it's a long journey, right? Like I've been
Yeah.
doing this now for 14 years. Like you can do hundreds of hours or weeks for a period. but you cannot do it for 14 years. Like nobody can. So
Yeah.
I think you need to think about that. There is also an interesting phenomenon that I think you learn and a lot of founders don't learn. When you do raise capital and you just have like a negative cash flow, you have it's almost like a time bomb, right? You have a deadline. You need to hit certain things by that time, and you need to raise more capital. Otherwise, you're going to be dead. It was a massive shift for us in 2017, 2018, when we had to turn cash flow positive because we didn't raise at the time. And like when you do turn cash flow positive, like all of a sudden the business like almost can go on forever unless there are massive problems or massive shifts in the world, which these days is a bit difficult to sustain. But in general, right, it can go on, right? And so like everything I think at that point changes. And also your mindset goes like, okay, as a person as well, I need to be able to function for a very, very long time. I cannot just function up to that moment. And so indeed, like a bit of balance and a bit of, I also think if you do work that hard, you don't learn fast enough to keep up with how things are changing these days, right? And I think that's almost a bigger problem compared to the others. If you don't have enough time to like say read something that is not connected with what you do, or talk to somebody that is not directly a sales prospect or something, you're not going to have enough external stimulus as a manager, as a CEO, as a founder to actually be successful in a world that is changing this fast, right? And the speed of change is increasing as well.
Yeah. Yeah, it's fascinating. On that note, what would be your recommendation of a good book right now, or something to read that you
Well,
recently?
I've been so I come from finance and computer science, right? So the furthest thing from me is sales, right? And I've tried to learn sales for like 10 years, and I asked hundreds of people how to do that, and nobody knew, and they introduced me to consultants, and I didn't like them. So I found a book that is actually here. I'm almost done with it. It's called The Qualified Sales Leader.
Can you
It's
pull it? Can you pull it? Oh,
it's literally about
yeah, yeah, cool.
from John McMahon, and it's literally about software sales, and it talks about like sort of foundational frameworks for software sales, which is exactly what I like. Like understand the principles, and then you can apply them in
Yeah.
a bunch of situations. And it's told as a story, so it's like kind of narrated. It's great. So
I love a book
yeah.
like. Is there any final words of wisdom, advice that you would like to share? You've given us so much already. Like anything from a valuation perspective for a founder or even an investor.
I mean, like one thing that I share that I think a lot of founders are still not doing is a lot of founders, when they go fundraise, they pitch the company as if it's going to do everything for everybody, be everything for everybody. And what we see a lot more opportunities in is in trying to reduce that perceived risk, right? So anything that you have done almost in the company at early stage should somehow shared with investors, I believe. Like even if it doesn't count for you as a milestone or something de-risking, it might be for the investor, right? So for example, the fact that you've got an office, the fact that you've got contact with a supplier, even though it's not a contract yet, the fact that you got a business registration ongoing, or that you had costs before, right? We have a lot of entrepreneurs. They want to hide how much they spent so far for some reason. Like, no, that's part of the business. That actually means that you've done something,
Yeah.
and you should show it off. So like almost show off everything you've done so far, because that's what sets you apart from all the other investment opportunities that they have.
I love it.
Yeah.
Daniel, thank you so much. I know that you're really active on LinkedIn, and you do write, a lot of thought leadership blogging as well. And so how do we find out more about Equidam, the merger? How do we find out more about you?
Yeah, indeed. So LinkedIn is probably my most active channel right now. Otherwise, equidam.com. We try to make that as informative as we can.
Amazing. Daniel, thank you so much. I know it's Tuesday. Well, Tuesday morning for you. So I'm going to go off and head to the park. Speaking of some active recovery, otherwise I'm going to get
Nice.
terrorized all night tonight with balls being thrown everywhere around the house. I don't know about your dog, but mine, he huffs and puffs when he's like annoyed at me. So thank you so much for your time. Thoroughly enjoyed it, and so many great insights, especially on core principles, the risk and the return. I just the opportunities and I guess possibilities are endless. But it's just knowing what your risks are from a founder and entrepreneur space. And yeah, stay tuned. Who knows what it's going to look like, the BC ecosystem in the next,
Indeed.
6 months, let alone 12 months. So thank you for your time, Daniel. I really appreciate it.
Appreciate it. Thanks a lot, B. Have a good day.
You too. Thank you.